In this module, we are going to study ISLM model. The ISLM Investment Saving Liquidity Preference Money Supply model is a macroeconomic model that graphically represents two intersecting curves. The investment saving, that is IS curve, is a variant of the income expenditure model incorporating market interest rates, that is demand, while the liquidity preference money supply equilibrium LM curve represents the amount of money available for investing, supply. The model explains how equilibrium is achieved when the demand supply equates. At the intersection of IS and LM curves, equilibrium interest rate and income level are determined. At this point, goods market represented by IS curve and money market represented by LM curve are simultaneously in equilibrium. A disequilibrium occurs whenever any of these two curves shifts due to change in exogenous variable like autonomous expenditure including fiscal policy and real money supplies. Disequilibrium is eliminated by appropriate adjustment in income and interest rate. Money market adjusts relatively rapidly than the goods market. Keynesian government spending multiplier and fiscal policy multiplier of the ISLM model are different from each other, with the latter being lesser in value than the former. Fiscal and monetary policy multipliers show the impact of changes in exogenous variables on equilibrium income. Let us analyze in detail the ISLM model. After studying this module, you shall be able to know the goods market IS and money market LM equilibrium. Learn how the equilibrium interest and income are determined when goods and money markets are simultaneously in equilibrium. Identify the disequilibrium and dynamics of adjustment in these markets. Evaluate the difference between Keynesian government spending multiplier and fiscal policy multiplier of the ISLM model. Analyze the fiscal and monetary policy multipliers in ISLM framework. Let us commence our module with the discussion of goods market equilibrium IS curve. The goods market is in equilibrium when aggregate demand is equal to income. The aggregate demand is determined by consumption demand and investment demand. This can be written as AE is equal to C plus I. Also, we know that income can either be consumed or saved. So, the identity Y is equal to C plus S. When goods market is in equilibrium, aggregate expenditure is equal to income. So, equating the above two equations, C plus I is equal to C plus S, I is equal to S. This is how the goods market equilibrium is explained as investment I hyphen saving S model. However, we know that government is also present in the economy and imposes taxes and does spending. The components of AE include AE is equal to C plus I plus G. The goods market equilibrium is established on the assumption that investment is not autonomous but a function of interest rate. It shares a negative relation with the interest rate. In the aggregate demand function, AE is equal to C plus I plus G when we introduce the investment function, which is a function of interest rate, we get the following. AE is equal to C plus I bar minus BI plus G. Putting the consumption function and equating AE to Y, we get Y is equal to A bar minus BI upon 1 minus B into 1 minus T. A bar is the sum of autonomous components. The intercept of AE curve is determined by A bar plus BI. Thus, any change in interest rate will shift the AE curve through its effect on the level of investment. If there is a fall in interest rate, that will lead to a rise in investment spending and shift the AE curve upwards, which will in turn raise the level of equilibrium output and income. When the corresponding points of equilibrium income and interest rate are plotted in interest income plane, we get the IS curve. This is shown in the two panel figure. In panel A of figure, the initial equilibrium in the economy is at point E0 where AE is equal to Y and rate of interest is R0 and equilibrium level of income is Y0. In panel B, the point corresponding to E0 is recorded as point A where interest rate is R0 and income at Y0. Now, when the interest rate falls from R0 to R1, investment spending rises and leads to an upward shift of AE curve. Now, equilibrium is established at point E1 where equilibrium income is at Y1. The point corresponding to this new equilibrium is point B at interest R1 and Y1. When points A and B are joined, we obtain the IS curve. Thus, IS curve is the combination of interest rates and income at which the goods market clears. All points on the IS curve represent the goods market equilibrium. IS curve is negatively sloped as a lower interest rate corresponds a higher aggregate expenditure. This condition of goods market equilibrium can also be represented in the form of IS curve equation. Y is equal to A bar minus BI upon 1 minus B into 1 minus T, or Y is equal to alpha G into A bar minus BI, where alpha G is equal to 1 upon 1 minus B into 1 minus T. The IS curve shifts when there is a change in any component of autonomous spending. So, whenever a change in autonomous spending like government expenditure or autonomous expenditure leads to a change in the equilibrium level of income, this increase is reflected as a shift of the IS curve at the same rate of interest. Next, we will discuss money market equilibrium LM curve. The wealth that a person has is kept either as money or non-monetary assets. The decision is based on the relative cost and benefits of holding money and other assets. The wealth budget constraint, which shows the combination of assets held by a person in the form of money and other non-monetary assets, implies that when the money market is in equilibrium, that is L is equal to M upon P, the bond market too is in equilibrium, that is DB is equal to SB. Therefore, the whole asset market can be analyzed by focusing on the money market. The money market equilibrium is established where the demand for money is equal to the supply of money. The demand for real balances demanded thus depends on two things: the rate of interest and the level of real income. The demand for real balances L can be written as L is equal to KY minus HI. The coefficients K and H reflect the income sensitivity and interest rate sensitivity of the demand for real balances respectively. This implies that real balance demand is inversely related to the interest rate and positively related to the income level. The supply curve of money shows the relationship between the quantity of money supplied and the market interest rate, all other determinants of supply unchanged. The level of money supply is determined by the monetary authority. The supply of money will be assumed to be exogenously given by the monetary authority M upon P, and it is unrelated to the prevailing interest rate in the market. The demand curve for money is drawn to show the quantity of money people will hold at each interest rate, all other determinants of money demand remaining unchanged. A change in any of those other determinants will shift the demand for money. Among the most important variables that can shift the demand for money are the level of income and real GDP, the price level, expectations, transfer cost and preferences. Let us understand the derivation of the LM curve. Suppose that the money market is initially in equilibrium at R0 with the supply of money M upon P and the demand for money curve L0 as shown in panel A of figure. In panel A of figure, the initial equilibrium in the economy is at point E0 where M upon P is equal to L0 and rate of interest is R0. And at this point, the level of income is Y0. In panel B, the point corresponding to E0 is recorded as point A where interest rate is R0 and income at Y0. As a result of increase in income from Y0 to Y1, the demand for real balances rises from L0 to L1. This increase in demand leads to an increase in the interest rate as the supply for money is held constant. The interest rate adjustment causes the money market equilibrium to establish again at E1. At this new equilibrium point E1, the level of income is Y1. The point corresponding to this new equilibrium is point B at interest R1 and income Y1. When points A and B are joined, we obtain the LM curve. Thus, LM curve is the combination of interest rates and income at which the money market clears. All points on the LM curve represent the money market equilibrium. LM curve is positively sloped as an increase in interest rate is accompanied by an increase in the level of income. This condition of money market equilibrium can also be represented in the form of LM curve equation. M upon P is equal to L. M upon P is equal Ky minus Hi or I is equal to 1 upon H in bracket Ky minus M upon P. In the money market equilibrium and in the derivation of LM curve, the supply of money is held constant, that is, exogenously given by the monetary authorities. Any change in the real supply of money will shift the LM curve. Moving on to simultaneous equilibrium in goods and money market, ISLM. The goods market equilibrium represented by IS and money market equilibrium represented by LM shows the different combinations of interest rate and income such that each of these markets clear and there is no excess demand or supply. For simultaneous equilibrium, interest rates and income levels have to be such that both the market are in equilibrium. This is shown in figure at the intersection of IS and LM curves at point E. At point E, the equilibrium interest rate is at R0 and income level at Y0. This equilibrium is established given that the exogenous variables like real money supply and fiscal policy remains unchanged. At the point of equilibrium, public holds the existing stock of money all points on LM curve such that the individuals hold the desired portfolio composition and planned spending is equal to output all points on IS curve such that firms are producing their planned output. Also, a major assumption is that price level remains constant. Any change in the exogenous variables will shift the respective curve and leads to adjustment in interest and income until the economy again achieves the equilibrium in goods and money market. Now, let us discuss disequilibrium and dynamics of adjustment. The simultaneous equilibrium in goods and money market is established given the exogenous variables like money supply, autonomous spending and fiscal policy parameters remain unchanged. Whenever any of these exogenous variable changes, one of the curve shifts and causes disequilibrium at the existing rate of interest and income. In order to achieve new equilibrium, there is an adjustment in the form of changes in both interest rate and the level of income. It must be noted that adjustment mechanism of output and interest rate is based on the following assumptions. First, whenever there is an excess demand for goods,
output increases, and in case of excess supply of goods, output decreases. This adjustment occurs with the change in inventories of the firms without affecting the prevailing price level. Second, whenever there is an excess demand for money, the interest rate rises in response, and in case of excess supply of money, it fails. This adjustment takes place because an excess demand for money implies an excess supply of non-monetary assets, that is bonds, which causes a decline in bond prices and a rise in their yields interest rate. This is because there is an inverse relationship between bond price and its yields.
In figure, the adjustment mechanism of disequilibrium is shown by the directions of arrows. The direction of arrows or the adjustment path is based on the previous two assumptions of interest rate and income adjustment. If the economy were at a point of disequilibrium like E1, then the adjustment is such that the interest rate as well as income level rises until the economy converges over time to the equilibrium level at E.
Another important fact about the adjustment process is that money market adjusts more rapidly than the goods market. Since the money market can adjust merely through the buying and selling of bonds, the interest rate adjusts rapidly and money market effectively is always in equilibrium. This assumption implies that when we are on the LM curve, any departure from the equilibrium in the money market is almost instantaneously eliminated by an appropriate change in the interest rate. The goods market, on the other hand, adjusts relatively slowly because firms have to change their production schedules, which takes time.
Moving on to equilibrium income and interest rate in ISLM framework. The equilibrium interest rate and level of income have been determined graphically at the intersection of IS and LM curves in the previous section. By working on those equations, we can find the same interest rate and income level which we derive graphically. IS curve equation: y is equal to alpha g into a bar minus bi. LM curve equation: I is equal to 1 upon h into ky minus m upon p. If we insert interest rate from the LM curve equation into IS curve equation, we get y is equal to alpha g in bracket a bar minus b upon h into ky minus m upon p. Solving this equation to determine equilibrium income, we get y0 is equal to gamma into a bar plus gamma into b into m upon h into p, where gamma is equal to h alpha g upon h plus kb alpha g. Previous equation implies that the equilibrium level of income depends on two exogenous variables, that is autonomous spending A bar and real money supply M upon P, and also the multiplier. Any change in these exogenous variables will lead to a change in equilibrium level of income in the same direction. Similarly, equilibrium interest rate can be obtained by inserting equilibrium level of income y0 into the LM curve equation. I0 is equal to k gamma into a bar upon h minus m upon h plus kb alpha g into p. This equation implies that equilibrium interest rate depends upon fiscal policy parameters, multiplier and real money supply. The equilibrium interest rate is positively related to autonomous spending, but it fails whenever real money supply rises.
Lastly, we will discuss fiscal and monetary policy multiplier in the ISLM framework. We can assess the effect of changes in fiscal policy and monetary policy on the level of income by using the equilibrium income equation. Equilibrium income equation: y0 is equal to gamma into a bar plus gamma into b into m upon hp, and the fiscal and monetary policy coefficients in the form of fiscal and monetary multipliers. The fiscal policy multiplier shows the change in equilibrium level of income as a result of change in government spending, holding the real money supply constant. Suppose there is an increase in autonomous spending as a result of increase in government spending, so that delta A is equal to delta G. The effect of this change in G is given by delta Y0 upon delta G is equal to gamma, where gamma is equal to H into alpha G upon H plus KB alpha G. Now the expression gamma is the fiscal or government spending multiplier when the interest rate adjustment is taken into account. It can be clearly seen that gamma is different from alpha G. The expression gamma is less than alpha G because it is multiplied by a fraction, H upon H plus KB alpha G. This represents the dampening effect of increased interest rate associated with the fiscal expansion in the ISLM model. When expansionary fiscal policy is adopted, it results in increase in interest rate when AE curve shifts up. This increase in interest rate discourages investment because in the IS curve, investment is a function of interest rate. So the income does not increase by that much because of crowding out of private investment due to higher interest rate. A higher interest rate sensitivity reflected in terms of high value of B reduces the multiplier effect due to large reduction in aggregate spending. If the interest rate sensitivity H for real balances is lower, that is almost 0, then gamma would also be 0, and in such a case LM curve is a vertical line. On the other hand, if H is very high, almost infinity, then this corresponds to horizontal LM curve and there will be no dampening effect on investment. A high value of K, income sensitivity of demand for money, would mean a lower multiplier value because in this case large increase in interest rate is required to maintain money market equilibrium as demand for money is too responsive to income. The monetary policy multiplier shows the effects of changes in real money supply on the equilibrium level of income, keeping the fiscal policy unchanged. When there is an increase in the real money supply, the income will rise by the amount of monetary policy multiplier. Delta Y0 upon delta M upon P is equal to gamma into B upon H. The monetary policy multiplier implies that the expansionary effect of an increase in real money supply on the economy will be higher when we have large values of B and alpha G. Also, as gamma is equal to H alpha G upon H plus KB alpha G, smaller h in K will lead to higher increase in income level. Now let us summarize what we have learnt in this module. First, the ISLM investment saving liquidity preference money supply model is a macroeconomic model that graphically represents two markets, that is goods and money market, which are simultaneously in equilibrium. Second, IS curve is the combination of interest rates and income at which the good market is in equilibrium. It is negatively sloped. Third, LM curve is the combination of interest rates and income at which the money market is in equilibrium. It is positively sloped. Fourth, the intersection of IS and LM curves determine the equilibrium interest rate and income level such that goods and money markets are simultaneously in equilibrium. Fifth, a disequilibrium occurs whenever IS or LM curve shifts due to change in exogenous variables like autonomous expenditure including fiscal policy and real money supply, and this disequilibrium is eliminated by appropriate adjustment in income and interest rate. Sixth, fiscal and monetary policy multipliers determine the magnitude of change in income level as a result of change in fiscal and monetary policy stance of the authorities.